Have you ever traveled abroad, pulled out your money, and suddenly felt super rich, or maybe surprisingly poor? You look at a price tag and have to do some quick mental math. Wait, a coffee costs asterisk, how many asterisk yen? Or, my $10 are worth asterisk, how many asterisk pesos? It's a common experience, but have you ever stopped to wonder why? Why isn't $1 simply equal to €1, or 1 Japanese yen, or 1 British pound? What makes these colorful pieces of paper and metal coins have such wildly different values? Today, we're going to demystify the world of foreign exchange and break down exactly why currencies fluctuate. It's a fascinating dance of economics, politics, and even psychology. And don't worry, I'll skip the boring textbook jargon. By the end of this video, you'll understand the key forces that make your money worth more or less around the globe. Let's start with the basics. The value of a currency, just like the price of your favorite sneakers or a vintage comic book, is determined by supply and demand. It's that simple. If a lot of people want a particular currency, its value goes up. If people are trying to get rid of it, its value goes down. This buying and selling happens on a massive global market called the foreign exchange market, or Forex for short. It's the biggest financial market in the world, where trillions of dollars are traded every single day. So, the big question is, what makes people want to buy or sell a specific currency? One of the biggest drivers is a country's economic health. Think of a country's economy like a company. If the company is doing well, making profits, and growing, people want to buy its stock, right? It's the same with a country. A strong, growing economy attracts foreign investment. Let's say the US economy is booming. Companies from Japan, Germany, and Brazil will want to invest their build factories, buy real estate, or purchase stocks on the New York Stock Exchange. To do any of that, they first need to buy US dollars. They sell their own currency, whether it's yen, euros, or reais, and buy dollars. This high demand for the dollar pushes its value up. Conversely, if an economy is struggling, investors get nervous and pull their money out. They sell that country's currency, increasing its supply on the market and causing its value to drop. A key indicator of economic health that traders watch like a hawk is interest rates. This one is super important. Interest rates are set by a country's central bank, like the Federal Reserve in the US or the European Central Bank. A higher interest rate is like a special bonus for holding a currency. Imagine you have a choice. You can put your money in a savings account in country A that pays 1% interest, or in country B that pays 5% interest. Where would you put your money? Most likely country B, to earn a better return. International investors think the same way. They are always chasing the highest yields. So, when a country's central bank raises its interest rates, it makes holding that country's currency more attractive. Investors from all over the world rush to buy it, which drives up its value. This is why announcements from central bankers are such a big deal. A tiny change in an interest rate can send currency values swinging. Another major factor is inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. You've definitely felt this when your grocery bill seems to get higher every month. A country with consistently low inflation tends to have a stronger currency. Why? Because its purchasing power is stable. If your dollar can buy roughly the same amount of stuff today as it could a year ago, that's a good sign. On the other hand, a country with high inflation sees its currency value erode. If a loaf of bread costs 10 pesos today, but 20 pesos next year, the value of each peso has effectively been cut in half. People lose confidence in that currency and will prefer to hold currencies from countries with more stable prices. Now, let's talk about trade. The balance of trade, which is the difference between a country's exports and imports, plays a huge role. When a country exports more than it imports, it has a trade surplus. For example, if China sells a lot of electronics to the United States, American companies have to pay for those goods in Chinese yuan. To do that, they sell us dollars and buy yuan. This increases the demand for the yuan, strengthening its value. On the flip side, if a country imports more than it exports, it has a trade deficit. It has to sell its own currency to buy the currencies of the countries it's trading with. This increases the supply of its currency on the market, which can weaken its value. So, a country that's a net exporter usually sees its currency appreciate over time. Politics and stability are also incredibly important. Money is a coward. It hates uncertainty. Investors crave stability and predictability. A country with a stable political system, a strong rule of law, and low corruption is an attractive place to put your money. People feel confident that their investments will be safe. But if a country is facing political turmoil, like a contentious election, social unrest, or a potential conflict, investors get spooked. They quickly sell off their assets and convert the local currency back into something they see as safer, like the US dollar or the Swiss franc. This sudden rush for the exits causes the local currency to plummet. We see this happen all the time during political crises around the world. Then there's government debt. A country with a large and growing national debt can be a red flag for investors. If the debt gets too high, investors might worry that the country could default on its obligations or be forced to print more money to pay it off, which would lead to high inflation. This fear can make investors sell the country's bonds and its currency, causing its value to decline. So, while governments often borrow to stimulate their economies, they have to be careful not to let the debt spiral out of control. Finally, there's speculation. Remember how I said the Forex market is huge? Well, a large portion of the daily trading isn't for practical reasons like trade or investment. It's pure speculation. Traders, hedge funds, and banks bet on which way they think a currency's value is going to move. If they believe the euro is going to strengthen against the dollar, they'll buy euros and sell dollars, hoping to profit from the change. These speculative flows can be so massive that they can create self-fulfilling prophecies. If enough traders believe a currency will go up and they all buy it, their combined actions will actually push the price up, at least in the short term. It adds a whole layer of market psychology and momentum to the mix. So, let's recap. The value of a currency is a complex cocktail mixed from several ingredients: the strength of its economy, its interest rates and inflation, its balance of trade, its political stability, its level of debt, and a big dose of market speculation. All these factors are constantly changing and interacting with each other, which is why currency values are always on the move. It's not that one currency is inherently better than another. A currency with a high numerical value isn't necessarily superior. A Japanese yen is worth much less than a US dollar, but Japan has a highly developed and stable economy. It's all relative and reflects the unique economic and political story of each country.